Hi, Kevin Blanch. We're going to talk today about, this is my basic fundamental lecture, but why you should always buy protection and the trick that all great hedge funds use. And know this, 90% of people who call them hedge funds are no hedge funds. Let's be clear, and if what's going on in the market does not prove to you what I've been saying for years, for 15 years, in my classes, in my lectures, the whole 9 yards, in my videos, you go back to my video, I'll put it up a year ago on my portfolio. We bought Apple, remember last year? We bought IBM last year. We shorted AIG last year. We bought Philip Morris last year. Of course, we shorted gold, and I've been dead wrong on that. But I've been 4 or 5 on things, but it doesn't matter if you're wrong, if you have protection, if you have dramatic moves. You could be dead wrong and still make a huge score. Or am I wrestling? Because that's what you're doing. You're fighting with these market makers. Okay, I'm going to show you guys a hedge fund trick and why hedge funds make all the money. Oh yeah. Yeah, that'd be Grant Wood, and that's what we've turned into. Okay. It's this simple. You buy an equity. Okay, what equity? Pick anyone. Okay, let's say Apple. That's the high flyer. Okay, you buy $10,000 worth. It's this simple. This simple. Between 3 and 6%. You buy the derivative under it for insurance. That's what great hedge funds do. That's why mega wealth remains mega wealth. They buy it. Can you guarantee a return? People say it can't be done. Madoff played on this because he wasn't really doing it. Because if he really was doing this, he said he was doing exactly this. But you can only do it up to a certain amount because there are only so many derivatives written. You know, these guys, and if somebody comes to you and say they're a hedge fund, first question you ask them, what derivative market are you trading in? And if they can't just spit it out right now, they're liars. And 90% of them are liars. These feeder funds that are feeding to you and they come to you, you guys that have got wealth, don't fall for these liars. Real hedge funds don't recruit. People go to them. Because there are very few of these guys sophisticated, and I'll show you why. Right here, right now. Okay, so you buy 3 to 6%. That's in an equity that has no dividend. My favorite one I've been buying, I know. I'm just talking in theory. I know I don't like giving any of these corporate scum money. Personally, I don't buy stocks. I buy derivatives because I wouldn't give these scumbags 5 cents. And if you're an individual investor, put your money in the bank. I've been saying it for years. This is freaking big fish eats little fish. Now, if you're sophisticated and you're running a fund or you even have a big position, you're an endowment, you're whatever, you got a fund that you're bashing, here's the trick right here. Okay, so you have a high dividend yield stock. Microsoft, any of them. Okay, say the stock is trading at $100. You take 3 to 6% of that equity. Okay, so you invest $10,000. Well, let's say $100,000. $100,000. You invest, what I like to tell people, you buy $94,000 of the equity. And you get the dividend. A lot of these things have got 4 or 5% dividend yields. When I started recommending for Philip Morris 2 years ago, that dividend yield was 7%. You got the big jump in the equity. But here's what you do. You take the other $6,000. Here's the trick. The $6,000. Okay, the first increment you use $3,000. $3,000. You buy puts on the said equity. Okay, in the options market. Okay, you go in the options market, you buy puts out of the money, not in the money, out of the money. That's the trick. Here guys like Kramer says, the only people that are buying out of the money are freaking rich. That's what a moron fool he is. He was just one of these guys, right place, right time. Got hold of by Sachs, born with a silver spoon up his ass, who went for 20 years up there and just got lucky. Those guys forced him to sell him, you know, thestreet.com right before. He takes both sides. He's a fool. Honestly, he really is. Right place, right time. Just because you get lucky and you're on Wall Street for 20 years and you were handed a freaking job and you sucked up all that money means shit. And trust me, a lot of these hedge fund, so-called hedge funds, a lot of the Wall Street guys are as ignorant as the masses, even more. They sell at the wrong time. There's a reason 10% of fund managers outperform the market, and it's the same 10%, and the other 90 underperform because they don't care. They're just making their fee in, they're making their fee out. They don't give a damn about your money, and you just keep feeding them. Quit giving these fools money. If you're bitching about Wall Street and you got money in a 401k, you have no room to talk because you're the ones feeding this animal and monster. But if you're a serious wealth and a serious hedge fund manager and you're a serious investor for the long term, this is what these guys do. So you buy $3,000 at the put out of the money. Say the stock's trading at $100 a share. I'll buy 85s strikes, and I'll buy them 2 to 3 months out. Usually about 3 months out. So what are we right now? We're August. So I'll buy November 85s, and I'll buy $3,000. Now here's the sophisticated trick, and this is why the average guy can't do it. You know they expire worthless. So you have to time it and roll it. Now, do you think this stock's just going to lay there the entire time for the 3 months? Hell no. You're going to get your chance to sell that option and roll back in. Now, you're going to have to take a little risk. Okay, so as the time expires, you get a month down the road, a month and a half, you sell that option and roll it back out into January's. And you do that over and over and over. Okay, then one day out of the blue, what happens now happens. The market loses 16% in 2 weeks. Okay, your equity takes a 20% hit. Say your stock lost 20%. Okay, of your 100,000, so now it's worth 80,000. You didn't lose a penny. You actually probably made money because that 3% to 6% derivative that you paid 20 bucks a piece for, what is it worth now? It's in the money. That stock went from 100 to 80. It's in the money, $5. That stock's worth $5 plus a tiny bit of premium. Okay, so you get $500 a piece out of those options that you bought a bunch of them for that you probably paid $20 for. You do the math. You paid $20 for them, they're worth $500. You 25 times your money there. So your 80,000 in your principal that was originally 100,000 with the derivative that you just bought is probably right around 120,000. Even though you lost. Now say the stock keeps rising and you lose a little bit, and you say, well, I'll give up some gains. Sure, you're going to give up a little bit of gains. You're going to give up 3 to 6% on an annualized basis. Less than an annualized basis because you roll that over and over and over. If you're smart and you're good about that, you can protect that 3 to 6%. You're using that hedge for years, for decades. That's what real hedge funds do. They buy high dividend yield stocks or they buy an equity. They roll that option, and sometimes they play both sides at the same time. It's called the straddle. They'll have calls and puts at the same time. They say, how can you make money, God? Oh yeah, dramatic moves. It's all about the VIX. It's all about volatility. Why do you think Sachs's number was so pathetic last year? There was no volatility. Stride 2 up, 1 down. Strip, 2 down, 1 up. That's the thing. That's why. This is a sophisticated issue. Oh, the derivatives are evil. I hear ignorant morons say that all the time. Without the derivatives market, the futures market, the options market, there are no protection. If they're used properly the way they're set up, they're beautiful things. They're buying insurance. Buy the protection. I've been ranting and raving saying that. And if you're an individual investor, get the hell out of the market. I've said that, well, you should have been out your whole life. Put it in the bank, let it compound. The power of compounding versus, oh, inflation. Well, you don't think inflation hurts stocks? You don't think, and we've had inflation for 10 years. Where have you been for 10 years? Kevin Blanch. Videotape.